You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody, and welcome back to the Infinite Banking Mastery Podcast. A common question I receive is, hey, I received a large lump sum of cash. What do I do with it? Or can I fund it into my banking system? Can I just put it all in year one and really get it started? Sometimes people have a large lump sum from an inheritance or from selling their business. There's all kinds of reasons, selling a house, and they want to just get that money in right away. Now, although this can work, it just depends on how much it is and how much the person wants to continue funding going forward. It usually isn't the best idea to fund the whole thing into the first year. Trying to stuff all the cash into year one can cause a bunch of different things to happen. So first of all, you're very likely to need a lot of term insurance inside of the contract in order to keep it from becoming a mech. Because remember, you have to have enough death benefit or the government will look at your policy and say, nope, that's not life insurance, that's an investment, and we tax all investments. So you can't have too little life insurance and too much cash going in. And so that's why you would have to add some term insurance inside the contract to boost up the death benefit so that you can fit those extra dollars that you want to put in. So if you do that and you want to put a large lump sum in all at once and then have a not so large ongoing premium payment, then you're going to need a whole lot of term insurance. And that takes away from your future insurability because you're insurable for a certain amount based on your income and roughly how many years left to a normal retirement age. And so if you boost that up by putting in a whole bunch of term insurance onto your contract, you're not going to be insurable. You might not be insurable for any more whole life, or at least not as much whole life as you would be if you wouldn't have put on so much term insurance into your contract. So it really limits your ability to grow your banking system. Let's just say in a couple years, you want to start another whole life policy and you have a certain amount of premium. Maybe you've had an increase in your income or you've had an increase in your business or a bonus or something. And now you want to fund a second whole life policy. And if your death benefit is too high or you don't have room basically to add in more death benefit or not as much as you need because you have a bunch of your death benefit, what you're insurable for, wrapped up into policy number one's term insurance rider because you wanted to fund it really high in that first year, then you're unable to grow a second banking system. That is a possibility. Now, your insurability is pretty high as compared to your income. It just depends on the numbers that you want to fund and if it's going to work out. But it does take away from your maximum insurability. And remember that premium dollars are what's going to be growing your banking system over time. So you don't want to limit your ability to fund in premium dollars because you can't acquire any more insurance because of such high term insurance inside of the contract. Also, that term insurance is taking some of that premium that you have going every single month or year to that policy. So not all of that base premium then is going to be funding your whole life. A portion of it will be paying for the term insurance inside. And so it's not going to be growing your system. And depending on how long that term has to be there for your policy not to become a mech, that's just 10, 15, 20 years that you have money that's not going to your base premium, that's going to a term insurance rider. Now, sometimes it works out, of course, where the term rider is a help and it works together with the policy to just make everything work out better for the plan that works best for you and your funding ability. But sometimes, especially when you're trying to fund a large lump sum, you just have to have such a large rider on there, a term rider, that it's going to eat away the base premium that you will not be growing your cash, then it's going to be going to term. And then when that term drops off, you can see how your base premium is very low because a chunk of it was going to the term. And of course, your paid up additions had to also drop off because you can't keep funding the paid up additions indefinitely. And so that base premium really becomes the fuel to your contract. So you don't want it to be too minimal, too low, because then you're cutting off the fuel for your future growth in the policy. Another thing that could happen from trying to shove in a bunch of cash in year one, it can cause your policy to mech very soon, or in the future, it can cause it to mech much easier. Also, the underwriter simply may not allow it. They will look at it and say, how in the world are you going to pay all this premium when your income is X? If your income is a certain amount and you just happen to have this large lump sum from some sort of windfall or sale of your business or sale of a home, or you have this large lump sum that you want to put into a contract, they still will be not understanding or confused or just wondering, how are you going to have a premium that high when you have such and such income? And so, because of the industry as a whole and people going out there and encouraging people to do things that they probably shouldn't have done or didn't make sense for all people, but maybe advisors or agents were blanket advising to people to do a certain thing, the underwriting with most companies, all companies that I know of, have limited now how much you can fund in premium, because they look at it and say, how can you fund any more than this into your contract, because you still need to pay for your mortgage and your food and your car and your cell phone bill and all your other bills. So it shouldn't be possible for you to fund more than a certain amount, about 25%, into a whole life contract. And so we also have that restriction. Now, they might allow an exception, especially if you have a really high net worth. They may allow an exception for how much you're going to be able, or how much they're going to allow you to fund into that contract. Or if we have a really good explanation for how you're going to fund the policy, they may allow an exception. But just overall, they don't understand or don't like to see when your premium is too high in relation to your income. And lastly, of course, you simply may not be able to just do it at all. You just may not be able to fund the lump sum at all because it is too much, too high with too little base premium. And even adding a ton of term isn't going to work out because that term has a cost, and that cost is further lowering your base premium. And so sometimes it just doesn't work out, period, or it is highly dangerous for a future mech. So just not a good idea. So then you might be asking, well, then what are my options? What can I do if I have this large lump sum and I want to use it for a whole life contract? How can I get the funds in there? And so oftentimes I will suggest to clients that we spread that money out over the course of 2 years, maybe 4 years, sometimes even longer. It really depends, though, on how they feel about holding on to those funds for that many years, because if we're planning to spread it out over 4+ years, the client might start to feel a little nervous that they might not be able to have the money and hold on to it that long to be able to fund that premium in those future years. And so sometimes we try to get it in there as soon as possible, but still spread it out over the course of a few years. If we can do it over 4 years, oftentimes that is best, at least for the structure of the policy. It will help it to run efficiently and be great. However, if we're unable to stretch it out over that many years, we can fund it in as little years as possible. And sometimes there's future growth in your business or future growth in your income or bonuses or tax return or something that comes up in those future years that helps you to actually fund at that higher level for a little bit longer, even though your lump sum is gone. Or maybe if you have that large paid up additions that we were using your lump sum for, and you get to year 4 or year 5 and you wish you could fund that full amount, but you can't, you can still fund as much as you're able to in that last year or the years to come. And it'll be great for your policy. You'll be able to get those funds in, and they will be growing for you for the rest of your life and working for you and allowing you access to them. Really, when we're building this policy, it very much depends on how much you feel you'll be able to fund in premium going forward once this lump sum has been transferred into the policy. So whether we're using the lump sum and funding the policy in its entirety every year, or whether we're using it as paid up additions or even just the base premium, however it is, what I need to know is how much are you going to be able to fund going forward? And that's going to help me to be able to build that contract in your best interest and to figure out how long I will need to stretch out those paid up additions or stretch out that lump sum value that you have Just knowing what you're able to do going forward is going to help me know how long we can stretch those funds out or how fast and quickly we can get them in. I always want to make sure that I am creating a sustainable policy for you, that once that lump sum has been all transferred in, that you can sustain the policy going forward. For example, if you had, say, $200,000 and you wanted to shove it all into the contract year one because you want to turn around and buy some property with it or something like that, and then you're telling me, well, but I can only afford 5,000 a year or 10, 20,000 a year going forward after I get this money in, I'm going to tell you that's a terrible idea. Let's not do that. That's not going to be great for your long-term growth. That's not going to be great for your contract. It's going to be likely to mech in the future, and it's simply just not going to be built well for what you really want the policy to do. And there's just going to be a better way to build it than that idea of shoving in 200,000 and then having this very low ongoing premium payment. And after talking and working with you and figuring out a plan, and it makes sense to use that lump sum and spread it out over the course of 4 to 7 years or something like that, and you feel concerned, like I have to hold this money for that long, because it is a legitimate concern. Certainly life happens and some of that money might be spent. And then how are you going to put it into your policy, and how are you going to follow through with your plan? So there is a way to send into the company a large lump sum and have them fund the premium for you over the course of however many years you want. There's some more detail that goes into that. That is an option. Although just keep in mind that they're still not putting all the money in at once. They're holding it for you so that you don't accidentally spend it on all sorts of things and you meant to put it into your policy. And then they will pay the premium once a year, because you can't pay the policy sooner than once a year, or that's too much money into the contract and it will mech. Although still, it usually is just best if you're able to simply have a plan for those funds and send them in once a year. And if we can work on a plan and you're able to be diligent and send those funds in over that course of that time to be able to get all the funds you want into your contract. If for some reason life happens and you get to year 4 where you meant to have a certain amount to fund your policy with, and it's not there, that it's not the end of the world, that we can always not fund paid up additions that year. Maybe you will actually have funds from something else unexpected, like I mentioned before, a bonus or tax return or a windfall of some other sort. But if you don't, and you can't fund that paid up additions for that last year that we planned or the last 2 years or whatever, it still was better for you to fund at the higher level for those beginning years and lock in the earning power of those dollars for the rest of your life than if you hadn't done it. And certainly you still have the opportunity to skip a year of paid up additions and then fund it again 2 or 3, 4 years later when your income maybe changes or increases. So that's all I have for you today. I hope it wasn't confusing. And if it was, and you'd like to work with me, please reach out. I'd be happy to explain it further and help you understand and help you construct the policy that you would really like to have for yourself and your family and have grow for you in your future and help you start the awesome infinite banking concept. You can reach out to me at Valerie@alphaomegawealth.com. I hope you enjoyed the podcast. Have a great week.
This is the podcastfactory.com.